So generally speaking, bonds do well when rates drop and don't do well when rates rise. So we could very well see a situation where shorter term bonds do better than longer term bonds. No guarantees, but that's something that we're been watching. In fact, much the last month, that's been the dynamic that's played out. So the bond market's going to be a very, very tricky one, we think, because a lot of the interest rate expectations are priced into the market. But even beyond that, there's nuance in terms of what duration and maturity makes most sense. Hello, everybody. This is John Llodra. I'm a co-founder and partner here at New Harbor Financial Group, here to give you our weekly market video. The purposes of these videos are to bring you data, insight, all for the purpose of giving you the information and tools and perspective, hopefully, to live more stress-free financial lives so you can focus on the things that really matter to your daily lives. What a week this has been. I'm going to talk about, I just want to make a quick mention. I did a standalone video, timely take video that will air to our channel right around the time this one will post. And that video is specifically on the Federal Reserve interest rate meeting this week, July 31st, Wednesday, July 31st. I'm recording this here on Friday, August 2nd, 2024. Not only that Fed meeting and what it has meant for interest rates, bottom line, I'll get to the punchline as that video gets into. It looks like a very good case that the Fed will drop interest rates coming at the September meeting, and probably more than initially expected. And the reason for that is we've seen dramatic deterioration in some of the job picture numbers, and the Fed specifically called that out as a concern that they're watching in the statement of their Fed meeting this week. I want to make it very clear that nothing in this is going to be personalized for any client or viewer, but I just want to give you a sense for some of the bigger picture things we look for here and will possibly expect as things unfold. But it's been a very, very volatile market, and I want to, talk about some of that. The first slide I'd like to share here is actually a chart that was put together by Allianz Global Investors. And they basically did a study of Fed rate cut cycles from 1981 to 2019. And they parsed it into two categories. One is cycles where the Fed rate cut was the harbinger of recession, oncoming recession. Rate cuts were unsuccessful in avoiding recession. And then there were other periods where rate cuts were, they labeled them here insurance cycles, that the cuts were able to avoid recession. I think we're very likely to see here, if indeed we do see a rate cut cycle here, that is likely to fall into this category. We have already seen some of these recessionary type things start to tick off. And what you see here is this shows the, for different types of assets, the relative outperformance, excess return versus cash. And what you see broadly here is bonds in these cycles generally do better than cash, outperform cash, but stocks and various some commodities tended to underperform cash quite dramatically in some cases. Gold is kind of neutral. I'll talk about gold specifically in a moment because we think it's a little bit more nuanced than that. But this speaks to a pretty dramatic picture here for most investors. Most investors are heavily invested in stocks and also, much less invested in bonds. And we, of course, have been very defensive. We've only got about 40% in stocks, so we're not too worried about this. Doesn't mean there won't be some potential downside action in portfolios, and we'll take defensive action as things unfold here. But clearly, the message here from most people is, in our opinion, you should be, really reviewing your equity allocations. If you're something in the order of 60, 70, 80, 100% equities, we think it's very timely to think about, not in a panic way, but in a systematic way, scaling back that equity exposure and perhaps increasing your bond exposure. Again, not meant to be individualized investment advice. This is just a picture of the S&P over time, going back to the 40s, I think. And the gray areas are the recessions. And you can see, even though the stock market oftentimes may start falling a little before the recessions are dated, it's during the recessions where we typically see a continued sell-off. So we do think there's downside in the stock market. This next chart is one that I've shared before, and it basically shows the last two bubble peaks, the tech bubble and the housing bubble. This is pre-Great Financial Crisis, both of which had more benign valuations than even we have now on some of the metrics that matter most. And you can see here, each one of these green dots is a Fed rate cut, and this blue line is the actual level of the Fed rate policy. You can see, despite very aggressive and dramatic rate cuts in both these episodes, the markets dropped, in both cases, over 50% on the S&P 500, on the index anyways. So we think there's considerable downside here, and we think defense is really important. This chart is looking at the last month. It basically shows the July returns through, I think, yesterday, August 1st. The reason I highlight this is it kind of in a picture expresses the kinds of so backing up again, we believe it's prudent for folks to scale back equity risk pretty dramatically. But then even within that reduced equity, it's really important to kind of be in the quote unquote right sectors. And this isn't meant to be a forecast. Past performance is not a future guarantee of results. But over the last month, you see some things outperforming here relative to others that are classically the kinds of things that tend to do better in the equity market during a recession. So top of the list here are the gold miners. I'm going to talk about that separately in a moment, gold and gold miners. But real estate here is a little bit of an enigma because I think most of the bounce is because of the interest rate repricings. The market is pricing in dramatic interest rate declines. That tends to favor things like real estate. But we do think that there's quite a bit of skeletons in the closet in the real estate sector that could likely lead to price declines in the coming weeks and months. Utilities, very defensive sector, up strong. We think, again, these are things that tend to do well during recession. Materials, likewise, that's very strong. Financial services, healthcare, defensive sector. Industrial is more of a cyclical sector. I would expect this one we see start to maybe soften here and be a little bit more challenging in the weeks and months ahead. This week, for example, we got the ISM manufacturing and manufacturing employment reports, not good at all. Really negative to the surprise to the downside. You see things like consumer staples. These are kinds of products, tissue paper, toothpaste, things that people buy no matter what's going on in the economy. But then the other end of the spectrum, you see things like energy and technology. These are and consumer discretionary. These are luxury items, discretionary expenditures that people generally only buy when they're feeling quite positive. These are the kinds of things that may likely start to struggle. Obviously, technology has been the worst, and that very well could be a place that we see some headwinds in the weeks and months ahead. The bond market is a little more tricky. While we do think that the bonds are likely, they've actually rallied quite a bit over the last month as interest rate expectations have come down. So in many ways, the market has front run the expectations on interest rate cuts. But we do still think that on a relative basis, bonds right here now probably our better place to be in some degree than broadly the stock market. There is nuance here, however, because not all bonds are created equal. There's different maturities and credit qualities. But even looking at the Treasury market, this is a chart that goes back to the 50s, I think. And the reason I wanted to put this out there is the red line is the yield on 10-year Treasury bonds. A common misconception is that interest rates go down during recessions. And certainly on the short end of the curve, the federal funds rate, the thing that the Fed says directly, that is usually the case. The Fed will cut and the rates will drop on the short end. But the longer term bond yields are set by a much more complex set of conditions, things, inflation expectations, fiscal deficit dynamics, what's going on in the broader global environment in terms of foreign buying of treasuries, things like that. And in fact, you can see during some recessions, again, the recessions are in the gray, you actually see the 10-year Treasury yields rise dramatically. Not always. So, for example, they dropped in the great financial crisis. But look in the 70s and especially the mid 70s and going into the 80s, rates rose higher. So this is a chart showing the Treasury yield curve. This is the interest rate. The blue line is as of yesterday, August 1st, 2024, and it shows for different maturities: 1 month, 2 month, 3 month, all the way up to 30-year. And you can see it's still mostly an inverted yield curve, meaning short-term rates are higher than long-term rates, with the exception of some like the 20-year and the 2-year, for example, and the 30-year, 2-year, the longer dated rates are higher. But I wanted to show you, compare that to the yield curve that existed prior to the recession in 2008. So if we look at, for example, the end of October 2007, you see that the short end of the curve, the difference here was pretty dramatic. We're currently at 5.25 to 5.5 on the Fed target rate. This was closer to 4% back prior to the great financial crisis. But you also notice on the long end of the curve, rates were higher. So generally speaking, bonds do well when rates drop and don't do well when rates rise. So we could very well see a situation where shorter term bonds do better than longer term bonds. No guarantees, but that's something that we're been watching. In fact, much less month, that's been the dynamic that's played out. Even if we go to jump out a year in the great financial crisis to the thick of it when markets are selling off, you had a much different yield curve. And you could see that even then, longer dated treasuries were higher than they are today. So the bond market's going to be a very, very tricky one, we think, because a lot of the interest rate expectations are priced into the market. But even beyond that, there's nuance in terms of what duration and maturity makes most sense. So the final thing I want to talk about is gold. Just today, gold reached a high above 2,500, all-time high. It's since pulled back, but we have record highs in gold. And I want to share a chart here that shows the longer term dynamics as to some of the key drivers of gold. Top panel shows the gold price in dollars. This goes back to 2005 or so. Then we have in the middle pane 5-year real Treasury rates. This is the yield on U.S. Treasuries adjusted for inflation, basically reduced by inflation. And then you have the dollar index. But quickly, what I want to call out here is typically gold does well when real rates are declining or the dollar's declining. And you see that, for example, in this period, real rates declining, gold went up. Real rates rising, gold went down. Real rates declining, gold went up. It's not a perfect relationship, but these are the key factors. So in this environment, if we are in fact looking at rate drops and recessionary type things, already we've seen the dollar drop pretty dramatically in the last couple of days. I would expect there to be very strong tailwinds for gold and gold miners. We've had a big rally here in gold over the last year or so, even despite these things not being tailwinds. So I think this added tailwind can certainly, almost certainly, lead to potential further upside in gold. That's all I want to share today. We're in a really tricky environment right now. Valuations are sky high, as we've been talking about for many months and years, frankly. So we think we're in a really tricky paradigm shift here in markets, and we certainly will be approaching it with discipline, not with panic, but calm discipline, using our tools and data to guide us and our clients, and hopefully what we think will be the right direction to write out any kind of episode we have here. I want to thank you for watching, and until next week, I want to wish you a great day. Thank you.